On June 1st, the American stock market closed at an all-time high. At the very same moment, oil executives were warning that crude could spike toward $160 within weeks, a record and a warning at once. Meanwhile, artificial intelligence has swallowed the dominant share of all new capital this year. Anthropic just filed to go public at $965 billion, now bigger than OpenAI. Almost everything good has already run. So where is the edge now? It isn't in the crowd, the hype, or the evidence, and this issue is the evidence. This is the Asymmetric, Issue 3, the terrain, tech and crypto investing for thoughtful retail, written from an operator's lens. Issue 0 mapped the themes. This issue walks the terrain, the full regime, then the specific places where the consensus and the evidence diverge. Markets are pricing three big things at once: artificial intelligence growth as near limitless, an Iran de-escalation as likely, and a smooth handover to easier Federal Reserve policy. Each is plausible, but all three are priced with very little margin for error, while the index sits at near-record concentration. You'll see the same labels throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, in 7 pieces. The 30-second frame. The Federal Reserve is on hold, with rates between 3.5% and 3.75%. Inflation is sticky, near 3.8%. The 10-year Treasury yields about 4.5%. The dollar is soft, gold sits near record highs, and the S&P just hit a record, around 7,600. None of that is a crash signal. It's a setup where what's already run is priced for perfection. Start with rates and inflation. April inflation ran near 3.8%, with the core measure around 2.8, above target, and not falling fast. That's why the Fed's own projected rate cuts keep slipping, now into the second half of this year and into next. The yield curve has normalized. The read, higher for a bit longer, don't pay today for a cut that keeps moving. Then there's the Fed itself. Kevin Warsh was confirmed as the new chair in mid-May and sworn in on the 22nd, succeeding Jerome Powell. Separately, the Supreme Court signaled it leans toward protecting Governor Lisa Cook from removal, a ruling expected around June. If a governor can't be fired over policy, that reinforces Fed independence rather than threatening it. The consensus hedges a politicized Fed. The variant is that the tail is closing. Underneath the on-hold rate, the Fed has quietly been buying short-term Treasury bills to keep bank reserves ample, while issuance skews to bills and the overnight facility drains. Mechanically, that adds liquidity, an easing impulse under another name. We are not in a melt-up, we are in floor building. Position for the next 12 months, not the next 12 days. The dollar is soft, near 99 on the index, and gold sits near record highs, the standout macro asset of the cycle, lifted by central bank buying and a debasement bid. A soft dollar, sticky inflation, and heavy government issuance is the textbook backdrop for real assets. Gold won the trade. Bitcoin, so far, has behaved like high-beta tech. Now the structure of the market. The top 10 names are about 36% of the S&P 500, down from a record 41% last year, but still among the most concentrated in history. The average stock badly lags the index, and tech has actually been one of the weakest sectors this year. The catch: concentration cuts both ways. The diversification you think you own is thinner than it looks. Against that sits a hot conflict and a complacent tape. Brent crude is near $96, up sharply on the day, with inventories near multi-decade lows and almost no spare capacity. Industry executives warn a real disruption to the Strait of Hormuz could push Brent to 150 or more within weeks. Yet equity volatility stayed subdued. That gap, fat-tailed risk priced cheaply, is the setup. And the capital wave. Artificial intelligence has absorbed the dominant share of this year's fundraising, around $380 billion. Anthropic confidentially filed to go public at a $965 billion valuation, now eclipsing OpenAI on a $47 billion revenue run rate. Micron has more than tripled this year on memory demand. The demand is real. But when one theme is this dominant, the marginal dollar is buying momentum, not value. Put it together: late cycle sticky inflation, a Fed easing under the hood, a soft dollar lifting real assets, an index dangerously concentrated in a few mega caps, an unpriced energy tail, and a capital wave crowding one trade. The macro doesn't say sell everything. It says the reward is in the uncrowded, cash-generative, survivable corners, and in keeping dry powder for the volatility the tape isn't pricing. Part 2, 4 sectors, the data, the mechanism, and the debate. First, energy. EQT is the largest, lowest-cost natural gas producer in the country, with a break-even near $2, meaning it generates cash across almost any gas price. The bull case is mechanism, not hope. Artificial intelligence data centers need baseload power, and gas is the only source that scales in under 5 years. The bear case, it's still a commodity. The read, downside cushioned by the cost structure, buy it on gas price weakness, not a rally. Second, healthcare. Cigna is the cheapest quality large cap on our board, near 9.5 times forward earnings. It guides to over $30 of adjusted earnings, generates more than $9 billion in cash flow, and has shrunk its share count 14% in 3 years. It already exited Medicare Advantage, the line blowing up its peers. At this multiple, the market is pricing almost no growth against a company compounding double digits and buying back stock. The fat pitch, discounted on a regulatory fear that's already priced. Third, industrials. Eaton is a wonderful company, the electrical equipment bottleneck of the data center build-out, with orders up 42%. But it trades near 30 times forward earnings, and the price already pays for a decade of growth. The risk is multiple compression when that order growth normalizes. It even fell on a strong quarter. An A-grade franchise, but the wrong entry. We'd want it 20 to 25% lower. Fourth, crypto. Bitcoin's long-term holders show seller exhaustion, and the liquidity backdrop helps, but it trades as a high-beta liquidity proxy, correlated to stocks, not gold. A real oil shock would likely hit it first. Among the rest, Hyperliquid stands out, the rare token with a cash return mechanic Wall Street can actually price, though still small and speculative. A signal worth flagging, physical artificial intelligence. Robotics is rotating into focus. Near term, it augments skilled labor. The personal robot future is still speculative. The durable way to own it is power. Every robot and every data center needs electricity. That points back to energy and electrical equipment, the picks and shovels of the build-out. What we are watching this week: any Iran deal or escalation, which sets the energy macro, Friday's jobs report into a complacent tape, the Supreme Court ruling on Fed independence, the first meeting under Chair Warsh, and whether Bitcoin holds 70,000. And we keep score in public. Cigna, attractive, constructive on weakness. Eaton, watchlist full price. Qualcomm, Nvidia, Micron, Coinbase, Zillow, all watchlist, each with a specific number to watch. These are dated, falsifiable calls, and we grade them. So where does it land? The map points at artificial intelligence everywhere. The terrain is more uneven. The reward sits in energy infrastructure. In cheap quality, the crowd has buried like Cigna, in Bitcoin on the right entry, and in keeping dry powder. The leaders are wonderful businesses, where price, not quality, is the question. That's the terrain. The asymmetric turns filings, flows, and market data into one disciplined read, for investors who want the evidence, not the noise. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.